Hello, welcome back to Rational Investing. My name is Cameron Stewart, CFA. Thank you so much for joining. I greatly appreciate the enthusiasm on the channel and all the interest. Thank you so much. Please comment, subscribe. Let me know what you think. Let me know what you want to do. Let me know what you want to see. Today we're going to look at NVIDIA. It's a hot stock. Everyone's been asking about it. It's part of our little mini series, Intel, AMD, NVIDIA. Before we do it, I want to remind you our core values, what we look for. This is an intrinsic value channel. We are dedicated to finding the value of a company, comparing it to the market, and looking at when the market eventually realizes the price is undervalued, they will close that gap and we will make excise returns. I'm primarily interested in beating the market. That's what this channel is dedicated to do, and we search for stocks that we think we're going to do it over a decade. How do we do it? We look at 5 key attributes. We look for top line revenue growth, earnings growth is defined by EBITDA, free cash flow growth, solid balance sheet, and a well-priced stock. I want to direct you to go back and look at my Domino's versus Google IPO video. That is a clear example of what a well-priced stock can do for the return. Domino's absolutely smoking Google with 5,000% return over 15 years. Why? Because it went public at a cheap price. It was overlooked. And even though I give it the 5th last characteristic in our stack up, it's probably the most single highly rated aspect that you can look for when making an investment. Buying a good company at a great price is much better than buying a great company at a bad price. All right, enough of that. You're here to watch NVIDIA. Let's dive right in. Now, this is their annual report. Nice 10K, a good solid 300 pages. Definitely print it out, definitely read it. What you're going to find is an outstanding company. Hats off to the leadership team there. They have built one heck of an enterprise. It is well positioned within the market. It has great cash flow. It has great balance sheet. I really, really like it. But let's go through the numbers and let's see why I would pass on it. Here we go. Revenue. Revenue starts at $4 billion and goes to $10 billion, almost $11 billion. Outstanding top line growth. That's 11% on an annual basis, which is really big for a large company, and I love to see it. So that the first box is checked, top line revenue growth. Let's look at EBITDA. So we're taking operating income, we're going to add depreciation, amortization, and we get EBITDA. EBITDA has gone from $852 million to $3.22 billion. That is an annual EBITDA growth rate of 25%. Outstanding. Outstanding, hands down. Like, when I look at the financials, when I look at the growth, there's no denying it. Top line revenue growth of double digits, bottom line revenue growth of twice top line. That means margins are expanding and top line's growth. That is parabolic. Fantastic. EBITDA, and we're going to run into a little issue here. EBITDA, we begin with a debt. They have debt, but it's manageable. That's fine, right? Debt, less cash. I love to see that when they have excess cash. In fact, Benjamin Graham, you go all the way back to securities analysis, the famous Benjamin Graham would love the balance sheet here because it's one of the rare instances where you have current assets are greater than all of debt. Absolutely outstanding. They have so much cash, so much AR, and so little debt that their current assets will take out all the debt. That is a rarity in these days with leveraged companies, and I love to see it. Kudos to the CFO for maintaining that. I really like it. So when we get value, right, we're going to take debt, we're going to less excess cash, which they have. We'll take the market cap, that shares outstanding, times price. We'll add it all up minus the cash, and you get enterprise value. Enterprise value started at $6.7 billion, and it has ballooned to $145 billion. Fantastic growth. And for those people who bought NVIDIA a decade ago, my hat's off to you. You could have instant messaged me and let me know about this one because I would have loved being on that ride. The stock has gone up tremendously, and you can see that from the value here, right? When we talk about expensive or cheap stock, I don't mean the actual price you pay. That's just a number that flashes on a screen. I'm talking about the relative price to enterprise value. That is how many years of cash flow, of EBITDA, are you giving up to buy the enterprise of the company, right? If I take the enterprise, $145 billion, and I divide it by their earnings, of 3.2. That is 45 years of earnings that I'm essentially giving to the seller, the person that I bought the stock. That means if they don't grow at all, I have to wait 45 years for that investment to pay back. Now, that's not why people that buy the deal, because that sounds terrible. They're buying it because of the growth. I get it. But the growth they have to experience for that to pay off is tremendous. And think about the Google IPO, right? Google went public at 22 times. Even 22 times is kind of expensive. And Google had meteoric growth, but its return, all been great, is not as good as Domino's that was cheaper, okay? So I think if you're getting in at this 45 target, that is very, very expensive, and it's going to affect the return. Certainly as they grow, that 45 multiple is going to come back down to an industry average or a market average, like the SPY, around 18 times, and it's gonna cap your return. But everything else looks fantastic. Top line revenue growth, definitely check at double digits. Earnings growth, check. Debt, outstanding. Ben Graham would love this company. But the price is looking expensive. Let's look at cash flow. Cash flow, we see the same picture here, right? Strong operating cash flow. 20% year-over-year growth, just like EBITDA, check mark for accounting standard, that's fantastic. CapEx is considerably less than cash flow from operations. That means every time they make a little investment into infrastructure, it pays off big in extra cash flow, right? They generate cash flow of $3.5 billion. They had to put in $600 million of reinvestment. That means almost $3 billion was free cash. They have almost no debt, so that cash passes through to the cash flow statement, to the free cash flow to equity. It's fantastic. So as a result, free cash flow per share is strong, and you get an average yield of 7%. Excellent. That's what we want to see. I want to say one thing though. I think that there has been a lot of share-based shareholder comp given in this company. Now, they're growing the stock price, they're hitting their numbers, good for them. But when they hit their numbers, they're getting large bonuses, very large bonuses. If you read this, that's in here, it lays it out. Management took 844 million, 555 million, and $400 million of stock comp, that's dilution to you in the last 3 years. That's massive. That's over $1.5 billion, almost $1.7 billion of dilution. That in order to keep this share count flat, they're using their cash to buy back the stock. And that means that's cash that can't be distributed to you. It is a cash cost, and they're paying management. Don't get me wrong. Reward management for excellent performance. This strikes me as a little rich, but I'm not going to knock them. The performance has been amazing, so that's really the only complaint I can find. So let's stretch this forward. Right? If we take this forward on a cash flow basis, what does the cash flow look like in 10 years? Again, I'm going to pick up the growth rate. I'm going to give it a 25% growth rate on free cash flow per share. I'm going to grow it in the future at a declining rate to be conservative, and it's going to produce a value. So I pick up my free cash flow per share of $8.77. I give it the growth rate, and I'm coming up for a long-term estimate of around $18 of cash flow to equity. I give that an average yield, and I get a 355 price tag. Same thing here with EBITDA. I pick up the EBITDA, continue the good growth, but not meteoric, because we have to have some rationale here, okay? And I give it a 20 times EBITDA multiple, and I get an enterprise value of $162 billion, less just a little bit of debt, less plus the cash that they would have, and I get $277. Let me show you what the issue is. The issue is, what's the price? $312. Okay, I got a $312 price today. I'm estimating, albeit conservative, you might argue that the growth rate is going to be higher, and I would agree with you. I think the the growth rate, they should beat that. But the point is, I'm not willing to pay for it. I'll give them some credit for the growth early on and give them 25% next couple years, fine. But long term, I'm going to force that growth rate down because I don't want to be buying for it. That means my long-term price target is roughly equal to what it is today. And that, when you put in an IRR, gives me 5%. Right, so just to recap for those new in the channel, what I'm doing here is I'm taking the cash flow that I generated in the other sheet, I'm bringing it forward. I'm entering my purchase price of current share price 312. I'm exiting at my 10-year forecast 317. Sum it up and discount it for an IRR, not discounting, just giving the IRR of this stream of cash flow. What that means is you make 5% on your money every year for a decade. And that is way too little for the risk you're going to take. In terms of a return, that's 1.5 times. You basically get your money back and a half a turn of your money over a decade. And there are other stock investments you can make that will return more with greater certainty. Or you can go into debt instruments that'll pay you roughly that with a little bit more certainty. So let's recap here. We've got top line revenue growth, outstanding. Earnings growth, outstanding. Balance sheet, rock solid. Ben Graham would love it. Free cash flows, excellent. Well priced. It is not. It's too expensive. All the growth that you're going to experience is already baked in the price, and you're essentially giving that up if you buy the stock now. What I would do is I'd wait for the stock to come back down to earth. Something's going to happen, and it's going to come down. Think of it this way. All right, if they generate an earn, they're at 50 times earnings, 54, I think. That means for every dollar of EBITDA, enterprise is $54. And that works going up. As earnings growth happens, you take the growth times 54, stock price moves up even higher. But it works inversely as well. If they should miss earnings, that 54 is a multiplier on the downside too. So you can see a wide swing on the downside, and that is a great time to consider entering the stock. What does it look like if I were to distribute that out? All right. So what we can do is we can give you a range. If I do the current price is 312, I'll go plus minus 10%, string that out to give you a range of stock prices. And if I plug that stock price into our model, it'll give you what the IRR is at different purchase price. So what you'll see is if you buy this stock, here it is. If you buy this stock at 312, which is where we are now, you get 5% IRR. Okay, not great. You need to wait for the stock price to come down. In fact, way down, below $227 before it ever gets near what we would be paying for it. So for that, I'm going to give this stock a meh. Why? Because I love the stock. It's just overpriced. So sit back, wait for it to come down to earth. Last thing I want to show you is what I would pay for the stock. So if they did $3.2 billion of EBITDA, I would say EBITDA and give this a 20%, 20 times handle of something reasonable, or even an 18 for the market, right? That would give you your enterprise value. You're going to subtract the cash. You're going to add the cash, subtract the debt. You'll add the cash. And I'm going to take this divided by the shares outstanding, which is here, $100. So I think if you can get this stock for $100, that's an appropriate price to pay for this type of growth. All right, my name is Cameron Stewart, CFA. Thank you for watching Rational Investing. This has been a review of NVIDIA. Hope you liked it. Bye-bye.